This remarkable individual was the first person to use technical analysis for U.S. stocks, the co-founder of the Wall Street Journal and creator of the Dow Jones Industrial Average. He went by the name of Charles Dow. In the first part, we'll look at his tragic background story, and in the second part, we'll dive into how he turned his life around to become a legend. The second part will include Dow Theory, the Dow Jones Industrial Average, and how he co-founded the Wall Street Journal. With so many setbacks and revolutionary creations, this story is definitely one that you'll find very interesting and inspiring. Charles Henry Dow was born in 1851, a time without phones or automobiles, let alone the internet or computers. It's hard to imagine what life was like for him growing up as a small-town boy in Sterling, Connecticut with no college degree. He was born into a family of farmers struggling to make ends meet, and to make matters worse, both his brothers didn't survive childhood. Life was very tough for young Charles, with his brothers passing away so young. Yet, this was just the beginning of his struggles. At only 6 years old, his father tragically passed away, leaving him with no option but to work on his family farm with his mother to put food on the table. However, Charles had a unique gift that would transform his tough upbringing to being one of the greatest Wall Street legends of all time. His gift was that he could easily break down complicated financial information to make it easier to understand. He quickly realized how much he enjoyed reading and writing about financial topics, which led him to pursue his dream of becoming a newspaper reporter. Despite being denied a college education because of his unfortunate circumstances, he was desperate to help his family. So Charles began a career as a reporter for the Springfield Daily Republican. During his 5 years at the company, he met a reporter called Edward Jones, who he would go on to achieve great things with. But it wasn't until 1880 that he managed to do financial reporting at Kiernan Wall Street Financial News Bureau, which is what he really enjoyed doing. While at the company, Charles persuaded his manager to hire his friend Edward Jones, whom he had met while working for the Springfield Daily Republican. His career took off when he began covering mining operations, as he didn't just report numbers, but also reported the story behind them. He realized that understanding the financial aspects of these industries wasn't just for executives, but it could also empower the average person. But Charles wanted more. He wanted to bring transparency and clarity to his financial reports for the general public, which meant he had to make a bold move. Uncovering Dow Theory and the Wall Street Journal. The bold move was to start Dow Jones & Co. alongside Edward Jones and Charles Bergstresser. The main edge of their business over competitors was to provide information quicker. However, their competitors had bigger budgets and were more experienced. The Wall Street Journal struggled to attract subscribers for years. They had to think of a new way. One day in 1882, Charles sat down with his co-founders. They decided to employ people to deliver the stock market news and analysis by foot every afternoon in the form of newsletters. The solution was simple and effective. In 1884, the newsletter reports known as the Customer's Afternoon Letter contained an 11-stock index, which would later become known as the Dow Jones Industrial Average. By 1896, the Dow Jones Industrial Average was first calculated using a basic sum and divide formula based on the top 12 stocks in the market. As of 2024, 30 stocks are in the average. Soon after, Dow Jones & Co. would create the first 4-page edition of its report, which they called the Wall Street Journal. The first publication was in 1889, and the new layout of the report gave readers far more financial information. Before the Wall Street Journal, investors would have to gather earnings information from companies individually, making the process far more time-consuming and unreliable. Additionally, the journal provided subscribers with stock quote information through a ticker tape. The Wall Street Journal eventually became a great success, as it was quickly known as a publication that promised accurate, timely, and unbiased financial reporting. Dow's editorial philosophy was simple: facts over sensationalism. Before the end of the century, Dow Jones was a widely respected name, and the Wall Street Journal had more than 100 employees. As its influence grew, it became a trusted guide for small investors and industry giants. But Charles Dow wasn't just a journalist. he was also a pioneer in technical market analysis. He's believed to be the first person to use technical analysis for U.S. stocks. Through his editorials in the Wall Street Journal, Dow began laying out a framework for understanding stock market behavior, which later became known as Dow Theory. The theory was an analysis of a market's maximum and minimum fluctuations, and it was first made clear in multiple editions of the Wall Street Journal. Dow Theory states that the market is in an uptrend if one of its averages goes above a previous significant high while followed by a similar rise in another average. For example, if the Dow Jones Industrial Average rose above a high, a trader would wait to see if the Dow Jones Transportation Average did the same to confirm the uptrend. Charles thought the stock market represented economic conditions and that stock prices reflected all available information. His theory was based on the efficient market hypothesis, meaning that he thought earnings, management capabilities, and other factors were already priced into a stock. Here are the 4 key parts of Dow Theory. 1. 3 types of trends. Primary trends can often last more than a year, while secondary trends are smaller moves that usually last a few months. The third type is called a minor trend, which usually lasts around a few weeks and is often just considered market noise. Also, it's important to be aware that primary trends remain until a reversal trend is confirmed. 2. Primary trend phases. Interestingly, primary trends have 3 phases. In bullish trends, we start the accumulation phase, which begins with an increase in volume. Next, we see the public participation phase, where retail investors come in and buy. Finally, we have the excess phase, where the market hits take profit targets and many start to exit positions. The bearish phases are essentially the same, but the inverse. First, we have the distribution phase, where the market starts to drop. This is followed by the public participation phase, where retail investors step in and sell, most often to cut losses. Lastly, we see the panic phase, where people lose hope and selling continues. 3. Trends are confirmed through index correlation. Charles Dow believed that for a new trend to be confirmed, we must have 2 indices signaling the same thing. For example, if the Dow Jones Transportation Average shows a primary downtrend, but the Dow Jones Industrial Average shows an uptrend, then a new trend should not be confirmed. Also, 2 opposing primary trends can't happen on 2 different indices. Therefore, a primary trend has to be confirmed with another primary trend on another market index. 4. Volume confirms the trend. Charles saw that trading volume usually rose if the stock price went the same way as the primary trend, and volume decreased if the price moved against it. If volume picks up, then it means the trend is getting stronger. For example, during a bullish trend, volume should rise. However, volume should decrease during secondary trends because investors should still be following the primary trend. For this reason, changes in the primary trend may sometimes be mixed up with secondary trends. A major challenge of Dow theory is that it's difficult to confirm whether a drop within a bull market will result in a significant trend reversal or just a short-term pullback. That's why Dow theory makes it clear that indices must correlate to help confirm a new trend reversal, as explained earlier in the third factor. Dow believed that markets move in 3 types of trends. Primary trends represent the market's overall direction, while secondary trends act as corrections and minor trends are short-term fluctuations. He also introduced the idea that market averages, such as industrial and transportation indices, can help reveal the economy's true health. Suddenly, one day, Charles Dow's health began to affect him. Due to his health concerns, he soon resigned in 1902. 6 months later, he tragically passed away. After his passing, Clarence Barron purchased Dow Jones & Company for $130,000 in 1902. It's fair to say the investment was a huge success, as the company was bought by Rupert Murdoch in 2007 for $5.6 billion. The Wall Street Journal is still a major success and remains one of the most respected publications in the world. When Charles Dow passed away in 1902, he left behind a legacy that helped shape finance. The Dow Jones Industrial Average, which he introduced in 1896, remains one of the most widely recognized indicators of the U.S. economy. Unfortunately, Charles Dow did not get to publish his complete Dow theory into a single document before passing away. However, his followers continued to develop his work, such as Robert Rhea's The Dow Theory in 1932 and William Hamilton's The Stock Market Barometer in 1922. Despite his brilliance, Charles Dow's journey was challenging. His company faced competition from companies with more funding and scale. Also, critics argue that his Dow theory was too simple, failing to account for economic shocks or anomalies like market bubbles. Yet, these shortcomings don't diminish his impact. Dow's vision for greater clarity and transparency gave investors better tools to navigate the financial world. His work on Dow Theory and creating the Wall Street Journal and Dow Jones Industrial Average had a significant impact. Make sure you check out these fascinating financial stories next. Thanks, guys.